$50,000. That's how much someone I know had to pay the IRS in taxes and penalties. Not because they tried to evade taxes, but because they didn't know crypto transactions were taxable. They didn't keep records. They didn't report anything. And when the IRS came calling, ignorance wasn't a defense. By the end of this video, you'll understand what the IRS knows about your crypto, the 5 tax mistakes that trigger audits, and the simple system to stay compliant. Because the IRS doesn't care if you didn't know the rules. They care that you broke them. Hit that subscribe button right now. I break down the complicated topics nobody else wants to talk about every single week. Here's what most people don't understand. The IRS treats cryptocurrency as property, not currency. That means every transaction is potentially taxable. Sell crypto for dollars. Taxable. Trade one crypto for another. Taxable. Buy something with crypto. Taxable. Get paid in crypto. Taxable. Earn staking rewards. Taxable. Receive an airdrop. Taxable. Every single transaction matters, and the IRS knows about your crypto. They have partnerships with every major exchange. Coinbase, Kraken, Binance, US, Gemini. These exchanges report your transactions. They send Form 1099 showing how much you bought and sold. If what you report doesn't match what the exchanges report, you're getting audited. Here are the 5 tax mistakes that trigger audits and cost people tens of thousands in penalties. Mistake number 1, not reporting crypto at all. The IRS explicitly asks on your tax return, at any time during the year did you receive, sell, exchange, or otherwise dispose of any financial interest in any virtual currency? If you check no when the answer is yes, you've committed tax fraud. The penalties are 25% of what you owe, plus interest. Mistake number 2, only reporting when you cash out to dollars. People think taxes only apply when they sell crypto for dollars? Wrong. Every trade is a taxable event. If you bought Bitcoin at $30,000, traded it for Ethereum when Bitcoin hit $60,000, you owe taxes on that $30,000 gain. Mistake number 3, not tracking cost basis. Cost basis is what you originally paid for the crypto. If you don't track it and the IRS audits you, they'll assume your cost basis is 0, which means they'll tax 100% of your sale as profit. Mistake number 4, thinking losses don't matter. If you lost money in crypto, report those losses. They can offset your gains and reduce your tax bill. But if you don't report them, you lose that benefit forever. Mistake number 5, not keeping records. The IRS requires records of every transaction. The date, the amount, the value in dollars at the time. If you can't provide records during an audit, you're going to owe far more than you should. These 5 mistakes are completely avoidable. So how do crypto taxes actually work? When you buy crypto, you establish a cost basis. That's what you paid. When you sell or trade, you calculate your gain or loss. Sale price minus cost basis equals gain or loss. Held less than 1 year? Short-term capital gain. Taxed as ordinary income at your normal tax rate, up to 37%. Held more than 1 year? Long-term capital gain. Taxed at 0, 15, or 20% depending on your income. This is why holding matters. The difference could be thousands of dollars. If you made 100 trades across 5 different exchanges, you need records of all 100 trades. With dates. With values in dollars at the time. This is why most people mess up. Tracking everything manually is nearly impossible. How do you track and report everything correctly? Step 1. Use crypto tax software. Tools like CoinTracker, Coinly, or CryptoTrader.tax connect to your exchanges and wallets. They automatically import transactions, calculate gains and losses, and generate tax reports. If you've made more than 10 transactions, you need software. Step 2. Connect all your exchanges and wallets. Every wallet, every exchange, every platform. Missing even one can throw off your entire calculation. Step 3. Reconcile your transactions. Review everything. Make sure transfers between your own wallets aren't counted as sales. The software is good, but not perfect. Step 4. Generate your tax forms. The software generates Form 8949 and Schedule D. These are what you file with your return. Step 5. Keep records for 7 years. The IRS can audit you up to 7 years after you file. Keep everything. This 5-step process takes a few hours once a year, but it could save you tens of thousands of dollars. Now let me show you legitimate ways to reduce your crypto tax bill. Strategy 1. Hold for long-term gains. If you're close to 1 year, waiting could cut your tax rate in half. Strategy 2. Harvest losses. Sell losing positions to realize the loss. You can use up to $3,000 in losses per year to offset ordinary income, and unlimited losses to offset capital gains. Then buy back the same crypto immediately. Unlike stocks, crypto isn't subject to the wash sale rule. Yet. Strategy 3. Donate appreciated crypto. Donate crypto directly to charity instead of selling it first. You get a deduction for the full fair market value and never pay taxes on the gain. Strategy 4. Use a retirement account. Some retirement accounts allow crypto. If you use a Roth IRA, your gains grow completely tax-free. Strategy 5. Track everything from day one. Accurate records mean you pay taxes on real gains, not inflated ones the IRS assumes. Here's what I want you to do right now. First, sign up for crypto tax software. CoinTracker, Coinly, CryptoTrader.tax. Pick one. Connect all your exchanges and wallets. Second, if you haven't reported crypto on previous tax returns and should have, talk to a tax professional immediately. The IRS has a voluntary disclosure program. Coming forward before they catch you means much lower penalties. Third, set a calendar reminder for the end of every year to review your crypto taxes. Harvest losses. Check holding periods for long-term rates. Do these 3 things and you'll avoid the $50,000 surprise. Hit that like button if this just saved you from a potential audit. I know taxes aren't exciting, but the IRS doesn't care if you think it's boring. They don't care if you didn't know. People who ignore this end up with massive bills, audits, and penalties that wipe out all their gains. Don't be one of those people. Now you know what the IRS knows. You know the 5 mistakes. You know how to track and report correctly. You know the strategies to reduce your bill. The only question is, will you actually do it? Now, protecting yourself from taxes is critical. But there's another way people are losing massive amounts that has nothing to do with the IRS. In my next video, I'm exposing the DeFi scams stealing millions from people who think they're investing in legitimate protocols. Click this video right here. And make sure you're subscribed with notifications on. I cover the topics nobody else wants to talk about every single week. Don't let ignorance cost you everything. I'll see you there.